Here we're going to be looking at bonds issued with detachable stock warrants, and we're going to look at the case here where the market value of the bond here is known, but the stock warrant market value here is unknown. And we're going to look at how we issue these bonds based on those facts here. So for example here, Corp A issued 3,000 bonds here of $1,000 par value per bond here, and they were issued at 102 or 102% of par. So each bond was issued with 2 detachable stock warrants. Now point 1 here, each warrant here was for 1 share of common stock with a specified option price here of $30 per share. Now point 2 here, after issuance of the bonds here could both be sold separately here at 98 or 98% of par here. Now that's, again, bonds wouldn't include the stock warrants. That's the bond separate price here on the market. Number 3 here, no market value can be determined for our warrants. So 4 here, we're going to be issuing these bonds with these detachable stock warrants. So based on the fact here that we don't know the warrants value here, we're going to have to determine it here. So this is where we use the incremental method here. So that's where you know the fair value of the securities, the known securities here. In this case, it's the bond, and use that as your basis here, and the remainder here when we do our allocation for our receipts or our proceeds here is going to go to the securities that are unknown here, and that's our stock warrant in this case. So okay, here's what we do here for allocation of receipts between the bond and the warrant. So when we sell the bond with the warrant here, well, we know that value here. It would be 3,000 shares here, $1,000 par per bond, and they're sold here at 102% when the bond and the warrant are sold together. That equates here to $3,060,000. Now we were told here that the bond sold separately here, which the warrant wouldn't be attached. That bond would, well, its value here would be 3,000 times shares, or 3,000 bonds times $1,000 par value, and it'd be sold here at 98% of par. So that value here would be $2,940,000. So we know what the bond's value would be here based on the issue, or what it could be sold separately here at 98%. Now this is where the remainder here is allocated to those warrants. So we had the bond plus the warrant here at $3,060,000. We know what the bond value here was, $2,940,000. So the difference gets allocated to the warrants here at $120,000. So now we can look at the bond to see if it was issued at a discount or premium. So the bond's par value, we got 3,000 shares, $1,000 par. So par value would be $3 million. It was sold here, or based on the the market price here after the warrant or the bonds were issued, here was $2,940,000, so that's less than the par value, so it would have been sold at a discount here. Our bonds payable, we'd have a discount here of $60,000 based on our known amount here on our bond value here when it was sold separate from the warrants. Okay, so now let's go and look at how we'd record this here. So here's the case. We got those 3,000 bonds issued at 102%, and there's going to be 2 warrants per bond, but each warrant goes for 1 share of common stock can be purchased. And that's not going to come into play because we're just going to look at the total warrant value in this case. So let's start out here with our cash account. So that's where we have the bond plus the warrant sold together here. We'd have 3,000 bonds, and the per bond price here with the warrant, it was sold at 102%, so that'd be $1,020 here per bond. So that equates here to debit or increase our cash here by $3,060,000. Okay, so we know what our cash receipts are. Now with those cash receipts with the bond plus the warrant, they're going to be allocated, of course, to our bonds liability here, and the portion that would be allocated, the other goes to our shareholders' equity, or increase in our shareholders' equity for a paid-in capital account here, the stock warrants. So that's what those cash receipts are going to be divided between. So let's look at what we do know here. So this is the case here where we know what the bond values are, and of course that's a debt liability, and the bond's par value in this case, of course, we had 3,000 shares here at $1,000 par per share. So we're going to come up with credit or increase our bond par amount here for $3 million. Now, the other thing based on that here, and the fact here that we can sell these bonds here at 98% after the bonds were issued with the warrants here, we can sell them separately here at 98%. So we have our bond par value here at $3 million, and then we're selling the bonds here at 98. We calculated that to be 2,940,000, so the difference gave us that discount here of 60,000. Debit our bond discount here, contra account to our bonds payable, reduces our bonds payable, but debited here for $60,000. That's known here. So we know what our bonds payable and our bond discount is. So those bond values are known here. Now, based on our bond known amount here and the cash we received, now we can determine the paid-in capital here for the stock warrants. Well, we already calculated that. That warrant value here was that allocated amount here of $120,000. We calculated that up above here. So you can see here this shareholders equity component, the warrant value, the total warrant value goes to a paid-in capital here for the stock warrants, and we'll look at that here, but let's look at our credits here. Credit of $120,000 here, and our bonds payable here had a credit of $3 million. So that balances with the cash we received here, debit of $3,060,000 plus our debit here to bond discount of $60,000. So what we want to look at further here with this paid-in capital. So if we looked at it in this terms here, so our paid-in capital changes the discount that we'd have on those bonds here. So if the warrants are not separable, then we would not have had any allocation to a paid-in capital for a stock warrant. So that would have been zero to go into additional paid-in capital. And based on that fact here, then we would have actually had a bond premium, because we would have had to receive $3,060,000 here versus the par value of $3 million. So there would have been a $60,000 premium here versus the $60,000 discount. So the point is, when we're dealing with these bonds with these detachable warrants here, and when we, in this case, we didn't know the value here of the stock warrant itself here, that we had to allocate that value based on what we did know. The known amounts here were for our bonds payable, the par amount here, and then based on the par amount here and the fact that we knew what the issue price was, or what we could sell that bond for after it was sold with at what we could sell it for separately here, then we knew what the discount is. So those are our known amounts here. So then the paid-in capital here, shareholders equity, the warrant based on the warrant value, that was the allocated amount here of $120,000. So that's how we would take care of it. Just remember, this paid-in capital here goes as a equity here, increase in our equity on our balance sheet, and that affects whatever our bonds pay, or that affects either a bond discount or a bond premium, whatever way you're looking at it, because you have to come up with that balancing amount here for the paid-in capital here. You would credit that here, and then your bonds payable, that was credited here. But there would be an effect. It would affect our bonds our bond discount or bond premium if we didn't allocate this paid-in capital here properly. Okay, so that takes care of our bonds issued here with detachable stock warrants, where the market value here of the bond is known, but the stock mark or the stock warrant value wasn't known here. So we had to allocate that stock warrant, and we use the incremental method to do it here. And you can just see our debits and credits here, how they balance out. Okay, so that takes care of our topic here in the bonds issued with detachable stock warrants, where the market values are one security is known, and then the other portion here, the other security, isn't known. Just remember here, your bond, of course, is a debt liability here, and then the paid-in capital here to stock warrants, that warrant value here is an increase in shareholders' equity. So just remember those distinctions here and how you make your balancing entries here when you come to allocate based on your known values here, or your known securities versus the unknown security amount.